Hello and welcome to SwitzerTV Investing. I'm Peter Switzer, and today our market's key index, the S&P ASX 200 index, ended only about 4% off its all-time high. Now this followed the US stock markets over the weekend, the Dow, the S&P 500 and the tech-heavy Nasdaq all ending in record territory. Spearheading the market today here was Zipco after talk of a listing on the US stock market and a roadshow to pitch its business to some of the big US funds. On tonight's show, we'll see what our experts think about Zip after a 13% rise today, which has been one of my favourites after I missed out on Afterpay. Junbei Liu of Tribeca Investment Partners and Julia Lee of Berman Invest will also tell us about the stocks they like right now as well. Mike Gable of Fairmont Equities will look at two stocks where the charts are saying to him, these are good buys. And Paul Rico will evaluate a number of quality companies that are now good value after being beaten up by the market recently. That's the show, so let's kick off with Junbei Liu, who manages Tribeca's Alpha Plus Fund. Junbei Liu, welcome to the show.
Hi, Peter. It's always great to speak with you.
Now, I'm going to ask you about some recent stocks that you've fallen in love with and added to your fund, but I have to talk to you about Zip today. It's had a very good day on the market. As you know, it's one of my favourite stocks, particularly because I missed out on Afterpay. Talk to us about, is it a stock that you like? I think in the past you said you have liked it. Is it a stock you like? And what was behind the big rise today?
Yeah, look, absolutely. So yes, we like Zip, and the same as we like Afterpay, and because we think the buy now, pay later space is only at its infancy. And so far, the data, monthly data that Zip has displayed and showed to investors has been incredibly strong. The result will be very strong. So, and it's much cheaper than Afterpay as well. Yeah. So on that basis, it's good. It's a good value stock. So, but the reason it rallied today is because they talked to that they're looking at dual listing. In one in US and one in Australia. Look, it's an interesting move because so far many of the biotech we've seen when they do the dual listing, it actually makes the value goes lower because the stock gets priced over in the US, and a lot of Australian biotech actually normally trades at higher premiums. So, but however, for Zip is different because in US there's not many companies that operate in that buy now pay later space, and the recent firm listing has certainly made Zip look really cheap. So if they do have a dual listing, certainly it means quite positive, it will translate positively to the share price.
Yeah, I was asked the question, why there's such a disparity between Afterpay's unbelievably high price and Zip. And I said to that person, well, look, will I eventually get either Larry Diamond or Peter Gray on the show, the co-founders of Zip? I'm going to objectively ask them, what percentage of their company is theirs compared to Afterpay? And if they say, well, and let's hope they tell the truth, and a CEO is supposed to tell the truth, but if he said, well, I think we're 10% of Afterpay, well, then they should be about a $15 or $16 stock. But have you tried to work out what relative proportion Zip is compared to Afterpay in terms of its revenue, in terms of market share and things like that?
Oh, look, of course. So Zip, well, to address that, first we talk to the percentage. So after they bought QuadPay, and that QuadPay is almost identical to Afterpay. Of course, a little bit smaller, but it's got great momentum, and the stats look really strong in the US. Much smaller, but it's got a great momentum. So that is very similar to Afterpay. Now that business is close to 50% if you look forward 12 months. So you can say 50-60% of Zip is similar to Afterpay. Now, but the other part of the business of Zip is more of a similar to a bit of a lending business, personal lending sort of business, because you can use their product up to $10,000. So the capital turnover is less efficient. So on that basis, people tend to think it's less less height over less growth prospect compared to the buy now pay later. But in a couple of years, when the QuadPay becomes huge, it becomes large enough, it certainly means that the Zip should trade on similar multiple.
Yeah, okay, a good answer. Now let's talk about the stocks that you've recently thought they look attractive and you've added to your fund.
Yeah, absolutely. So there's quite a lot. Look, this is reporting season, so we're paying a bit more attention to what result is to come out of this reporting season. Some of the names we added more so are we're still in the retailer space, but more so is the housing retailer. So because our view is that the housing retailer will continue to do quite well, and the tailwind will be there for a couple of years. Just look at the listings and housing turnover and the housing prices, if you like. We just heard from real estate REA. Things are looking very, very strong in the next 12 to 18 months. So housing retailer, you want to buy more Harvey Norman. We did buy quite a bit of Nick Scali, and I think that business has quite a lot of tailwind for quite some time, and that business still looking very good. Just reported, but still I think upside is still quite strong. Also, there's a couple of other stocks as well. We also looking at some of the builders that heading into this reporting season as well. Normally they're a little bit lower quality businesses, but the macro environment is so good for renovation, for building activities in Australia and in New Zealand. So some of those businesses have struggled for years, and finally stars are aligning. Things like Fletcher Building, it is looking pretty strong. James Hardie, I think the result will look pretty strong tomorrow, and I think that's going to do very well on the basis of it. So the building material space is very strong. Do you want me to keep going? I can keep going.
Yeah, you can keep going until I fall asleep if you like.
I'll just keep talking. Look, I think just in terms of the result, just things that would deliver strong result. I still think Domain would deliver very good result just after what we heard from REA. We think Southern Cross, the media, Channel 9, Southern Cross, the media space, actually you should see very strong numbers. Even Channel 7 will see very strong numbers because some of the SMI data has been strong.
Yeah, but Junbei Liu, once upon a time we were saying old media really was in trouble. But of all those companies, you mentioned Southern Cross first, and Southern Cross is in radio and television. Nine, of course, has newspapers as well as radio stations and, of course, the Nine network, and even Seven. Why have things improved for the old media?
That's a really good question. Look, what's really changed at the moment? The structural issue, so the long-term pressure on newspaper and TV hasn't changed. But what's really changed was last year, the COVID-related shutdown and economic slowdown has really impacted those traditional media businesses enormously. And so a lot of them has went out and raised money and make sure they have good balance sheet, but there was no revenue. But now, 12 months on, retailers are doing well, corporates are doing well, consumers are spending. So we are seeing the advertising market actually is turning for the first time in a big way. We haven't seen growth in the advertising market, especially TV, for so many years. And now we're seeing double-digit growth. So these big media businesses are very leveraged to that top line revenue line moving. So earnings growth is going to be enormous for that sector. So for now, they're very cheap and they will deliver pretty good growth numbers.
Yeah, and I guess looking at Nine, for example, the addition of Stan is a plus, and you can actually watch the programs you've missed on their streaming services as well. They have actually diversified, haven't they, the old media businesses?
Absolutely. Amongst the old media businesses, I would say Nine is best of the bunch because it does have good exposure. 60% of the value or 50-60% of value come from Domain, exposure to Domain. And then quite a bit of value come from Stan, which is a new media like the Netflix, but the Australian version. They've done incredibly well. And then the TV version, which is, it's still on the way up as well. So to buy a media company that has diverse exposure, I think that one looks good. We also just heard from News Corp as well. The newspaper is not doing too badly either. So, that whole traditional media space is looking pretty exciting this 12 months.
Junbei Liu, thanks for joining us on the program.
Thank you very much.
This episode was brought to you by WCM Investment Management, a California-based global equities manager with an outstanding long-term track record. This chart shows the significant outperformance of WCM's quality global growth strategy over the past 1 year, 3 years, 5 years, 10 years, and since its inception. Investors can access the strategy via the ASX with their choice of an exchange-traded managed fund, WCMQ, or a listed investment company, WQG.
Well, joining me now, as she does weekly, is Julia Lee from Burman Invest. Thanks for joining us, Julia.
Great to be here, Pete.
Okay, now, Julia, I have asked you to tell me the stocks that you've recently thought were good enough to add to your portfolio, or ones that you really like now. But I just want to cover off on Zip. Zip's had a really good day today. I know you're an Afterpay fan, but at other times you've seen value in Zip. What's going on there?
Pete, whenever you look at companies, it's the new information which adds value to the share price. And with Zip, they've said that they're focusing in on the US, which is a huge market and where the momentum really has been. If we have a look at Afterpay's numbers, or even if we have a look at PayPal, which recently looked at the buy now, pay later space, the momentum in the US is quite strong. So the fact that Zip's looking to enter into the US and focus in on the US has been very positive for the share price in terms of both attracting new investors as well as new users of its product.
Yeah. So the news that came out today, did it have any influence on your view on Zip?
I guess if we have a look at the buy now, pay later space, I think competition is ramping up over in the US. My view is longer term, it's still best to go with the leader. And for me, in my mind, that's still Afterpay. But in the short term, Zip's doing a bit of catch up because of that extra new information.
Yeah, okay, great. Let's go to the next story, and that is the stuff that you like right now. Some companies that have come on your radar screen in recent times.
Well, Pete, this is a high-risk time to be putting out new stock picks, and that's because we're in half-year reporting season where stocks can jump by 20 or 30% and fall by as much within the space of a month. So having a look at this half-year reporting season, one of the stocks I really like is Domino's Pizzas. And this is not just pizzas in Australia and New Zealand, but also in Japan, Germany, as well as France. Now, lockdown has helped this company, but really we're seeing quite some strong momentum happening. And when you look at a retail stock, the combination that you want is you want to see an increase in sales together with a rollout of stores. And that's really what we're seeing for Domino's. We're seeing a record number of new stores being opened in Japan, and over in Germany, the basket size is increasing, so people are spending more money on pizzas. Domino's really doing well because of the scale of its delivery network. And of course, here in Australia, things looking pretty good as well. So that magic combination of an increase in sales and a rollout of new stores, that strong momentum, I think is going to continue for Domino's even after COVID's passed.
Now, its share price has had a nice run, but you think there's more upside. And I've got to say, Don May is a very good manager of that business.
Absolutely. And look, there has been a new CEO of Europe, and I think he's making a bit of a difference over in Germany and France as well, which is great to see. But, you know, Japan has been a strong point. Germany's been a strong point. The momentum here in Australia is good as well. And look, this reporting season, there's a few retailers that I'm keeping an eye on. We know that the housing market's been doing really great, and that's going to be positive for the building material companies like Boral, but also the likes of Nick Scully has reported well. Harvey Norman should do well. JB Hi-Fi should do well out of that. And I really like Genworth mortgages. We're seeing more and more first-time homeowners jumping into the market. So mortgage insurance, I think, is going to make a comeback over the next 2 to 3 years.
That's a big call, Genworth. I think your analysis is right. There will be more loans, and Genworth's right in the position to benefit from that. Now, one thing that Junbei Liu quite surprised me this afternoon when I was talking to her was she said that some of the old media companies are looking a little bit more attractive. Are you seeing the same thing?
Yeah, I think News Corp was a very strong one. We saw the results coming out of that, and we have seen earnings upgrades coming through. And I guess when you have a look at economic recovery, which we're looking at in 2021, there's a number of sectors and industries which derive their growth from that. One obvious area is the banks, which is a reflection of economic growth, especially housing growth. But also if you have a look at media and marketing companies, they benefit from growth in the economy because there's more spend in terms of marketing. So I think those old-time media companies, they will potentially do well. The big, I guess the big wild card for me is whether the Australian government can get the likes of the big giants to pay for some of that media content. And if that's the case, probably a winning formula for something like Nine. But, the media companies, the marketing companies, they should do well from economic growth as well as the banking space.
Yeah, I must say, look at Nine. Nine looks like the company is diversifying the best in my eyes. I think Stan is a good addition to their team. And the fact that Stan's even doing rugby this year, that's a diversification thing which a lot of free-to-air channels haven't chased it. But I think there's a boutique audience there, and a lot of the advertising dollars will follow rugby as well.
Yeah, I think one of the things that Nine does really well is focusing on sports. And of course, when you're looking at sports, there's not a lot of places to go. So it has that edge there. And as you mentioned, Stan as well, we've been at home watching more television. So the subscribers in Stan, that's an attractive looking unit as well. So look, Nine Entertainment, the shares have been rising over the next few months. But as economic recovery takes place and there's more advertising, marketing spend, it should be a beneficiary.
Julia Lee, thanks for joining us. Talk to you next week.
Thanks, Pete.
Well, joining me on the program is Mike Gable, the founder of Fairmont Equities. And invariably when I get Mike on the program, I want him to either tell me whether I'm right or wrong about a stock that I might like, or ones that are pretty popular in the market right now. But this week I asked him to bring two stocks that he likes, and let's see the charts that might support that liking. How are you, mate?
Good, Peter. How are you?
Very good indeed. So the two stocks you've got, Aristocrat Leisure and Incitec Pivot. Let's kick off with the first one, Aristocrat, ALL.
So Aristocrat's a company that we've liked for a long time.
You have?
Analyst loves the business, and it's done really well for us over time. Why I thought I'd highlight it again here, Peter, is after a period of consolidation at the end of last year, it's really on the move again. And I've noticed in the last couple of weeks, stocks with US dollar earnings are starting to get a kick along again because the US dollar has stopped falling and looks like it wants to head higher. But Aristocrat's strengths are beyond just the currency, of course. So
the currency is a headwind, but you believe in the company's potential, don't you?
Yeah, exactly. They've got they've grown quite nicely in the US. Sure, there's issues around COVID and the rolling out of the machines, but they have increased their market share in gaming machines in the US. Obviously, in the US, things are a little bit more open in terms of the casinos than they are here domestically. But Aristocrat's also expanding into the digital space, and they're doing quite well there. So it's a business we like. In terms of the chart, what I'm trying to highlight here on the screen is we could see towards the end of 2020, the shares did pull back and underperform the market for a period of time, but they found some good support just above $28, which was near the November low. And then most recently, what I've indicated with that little blue line is there was some resistance at $32, but it popped above that about a week ago. So in my opinion, it looks like it's back on the move. It might slow down in the next day or two because it's getting close to that November peak, which is near $35 naturally. But I think any stalling here in the share price of Aristocrat's an opportunity to buy. The way I read the chart is the next step for this is to retest that February peak near $38, and ultimately it should go beyond that. I mean, this is a company that has earnings growth, double-digit percentages every year, so you'd expect the share price to follow suit.
And you have to say that as a business, and what normalcy might have looked like when it was $38, it's still way off. In Australia, people aren't going to Crown casinos and all the other ones, even clubs and all that sort of stuff, to the same extent as they used to because of social distancing. America would have the same sort of problems, some states different than other states, but the bottom line is we're a long way from normalcy. So when normalcy hits, that $38, it looks like it could easily be tested. But some people who watch this might say, well, Why do charts actually give him that confidence to say that? What makes you think that the numbers as portrayed graphically there are any guide to anything? Because I'm asking you to explain to people who don't understand the value of charts why you think charts are valuable.
So I want to buy, any asset that I want to invest in. I want to invest in something that's going to go up. And
gee, that's unusual.
But see,
if you're a
the
short
thing
seller,
is,
you wouldn't.
But it's funny. A lot of people buy declining assets. They see a chart that's falling. They think, oh, this is great. I'll buy into this. But they don't know how much further it can decline because, I'm in the market as well as thousands, millions of other participants. So what those other participants are doing is very important. So I'm not arrogant enough to say, I believe that I'm correct and however many million other people are wrong. I mean, it doesn't matter if they're right or wrong. They're the ones who are pushing the share prices in one direction or the other. And if I can tell on the chart that all the other participants are stepping in at certain levels to buy, if they're able to raise it to a certain price, if I could see they're selling at certain prices, it just makes me, I guess, a little bit more confident that if they're buying it at the right price, then I can sort of join in and at least I'm catching something that's on the way up.
So it's a graphical portrayal of the votes for a company. Yep. And if you're feeling that there's more votes for it than against it, you think, okay, that's a good reason to think about this company. You look at other factors and that gives you even more support. That's exactly what I do as well. Great stuff. Let's go to the next one. Incitec Pivot. Now, this is not a company I like because sometimes it can come up with really strange market announcements and it can go, but the chart's looking pretty good.
Yeah, look, I think this one has some upside ahead of it. Yes, it's not your typical blue chip. I thought this would be something a little bit different to the other companies in the space. Yeah. I mean, in the mining space, at the moment, BHP, Fortescue, Rio, to me, they look a little bit soft in the way they're trading, and maybe that is a currency thing at the moment. The market's a little bit concerned. I think they'll do well longer term, but if you're looking for, I guess, a resource related stock outside of the top three, I think Incitec Pivot's worth looking at. So a lot of their business is in explosives. So obviously explosives are used by the big miners here and overseas. But they're also, as a chemicals company, they're also involved in fertilisers, and fertiliser prices at the moment have looked like they've found some support and are heading higher. And of course, as I've mentioned before, I think resource stocks will do well this year. I think we're still in the phase of a commodities boom. Yeah. And obviously the demand for Incitec Pivot's products will continue to increase.
And the diversified too, by being both fertiliser and explosives, Yeah,
exactly. So I think there's good upside for the business. And in terms of the way it's trading, what we could see here is a share price which, after not really performing too well in the middle of last year, has really started to step up. And I've indicated that with the horizontal blue lines. We could see that the share price rallies a bit. It gets to a point where there's a lot of sellers, and then it eventually overcomes those sellers. They've taken their profits or losses or whatever they've done, and they're out of the way, and then it's able to move higher again. So we're seeing this very nice gradual step up. I don't like buying stocks that making huge moves in such a short period of time because it's unsustainable. This is, to me, looks sustainable. At the moment, what it's done is it's hit about 280 a couple of weeks ago. It pulled back, so there are some sellers at 280. It's gone back to that 280 level quite quickly, and I can see in the last few days that although there are sellers at 280, they're not scrambling over each other to get out of this thing. And if that was to occur, it would push the share price a lot lower. But the fact that, sure, we have sellers at 280, but it's still hovering in there, that's telling me there's still a lot of buying coming in. So
it's bounce back so you can see it.
Yeah, so what I would do is, if I was looking to purchase this one brand new, I'd wait for all those sellers to get out of the way just to make sure that we do have a clear road ahead of us. So if you see Incitec Pivot in the next few days or so trade above 280 and close above that, in my opinion, that would be the buying opportunity because those sellers are out of the way, and then this should have a run up. and the next line of sellers probably isn't due until, as we could see at the left side of the chart there, sort of around 320 to 340 is a previous level where some unfortunate souls bought it a bit too high, and they're waiting to get out at break even, because the other part of investor psychology is, when people are sitting on a loss, they tend to hold on to things until they're break even. And unfortunately, they get out at break even, the thing just keeps going because it's going back up for a reason.
And its real fall from grace was linked to the coronavirus crash, isn't it? It was a $3.40 stock before the coronavirus came to town. All right, mate, and just generally, I know you look at the market generally, and I saw some short-term and some medium to long-term analysis, and that analyst was saying the market's looking pretty bullish. Are you seeing the same thing in your charts?
Yeah, look, the market's been a bit interesting the last couple of weeks because volatility has increased again. So to me, that's a little bit of a warning sign. A couple of weeks ago, we did take a little bit of money off the table for clients, and now I just want to see where it's going to head to from here. So I know the market's had a good few days. It looks like it does want to head higher, but I just get worried when you have these big moves from day to day. So usually the best results in the market is when volatility is really low and you just get this incremental rise each day. But look, volatility has me a little bit concerned short term. Whatever it wants to do from here in the short term, come back or continue to edge higher, we'll see. But beyond that, for the rest of the year, I think by the end of 2021, we're going to see much higher levels on the share market.
Yeah, the chart I liked on the weekend, and I don't know whether you've seen it, that both hospitalisations and infection rates in the US are starting to fall pretty well. The death rate's falling at a slower rate, but it was quite a significant turnaround. And I think if that trend can be continued, I think it will show up in the stock market.
Yeah, we're heading in the right direction.
Yeah. That's Mike Gable, Family Equities.
This episode was brought to you by WCM Investment Management, a California-based global equities manager with an outstanding long-term track record. This chart shows the significant outperformance of WCM's quality global growth strategy over the past 1 year, 3 years, 5 years, 10 years, and since its inception. Investors can access the strategy via the ASX with their choice of an exchange-traded managed fund, WCMQ, or a listed investment company, WQG.
Well, in today's Switzer report, I actually looked at 5 quality companies that have been beaten up by the market. And I posed the question, are they good long-term buys? And I thought I might just chat with Paul Rickard about it. Paul, thanks for joining us.
Thanks, Peter.
Let's go through the companies and in order. The first one was CSL. I know you like it, I like it. But the question is it buy it now before the report, or do we buy it after the report?
Yeah, I'd probably be inclined to buy it before the report for 2 reasons, Peter. One is that CSL has a habit of surprising. Yeah. It has already posted guidance. Now, guidance of sales growth, I think, is between 3 and 8% 6 to 10% in constant currency terms, and net profit growth of between 3 and 8% in constant currency terms. So CSL never misses guidance. So and has a habit of surprising on the higher range of guidance. So the market is pretty bearish on CSL because they've been, when I say bearish, I mean it's in a relative...
They're not as in love with CSL as they usually are.
It's in a relative state because they've been very worried about the collection of plasma in the US, mainly because of COVID-19. They really rely on, in many cases, a lot of lower paid people going in and getting paid to donate blood plasma. And some of those cities and some of those places, they've been harder hit by COVID than others. And so a lot of research reports saying that, collections have been slow. That means they can't manufacture what they need to manufacture to generate the revenue. That could be the case, Peter.
That's like a now problem, but that's part of the reason in the future that problem won't be there. But go on.
Yeah, so I'm not as worried about that as others, and I think that we're just seeing a few currency headwinds and the market sort of either with CSL or sort of in the... I just think it's the opportunity to buy beforehand. So that's the one I would buy before the result, I think.
Okay, let's go to another one. IAG, a good insurer, and you and I have talked before, Warren Buffett's invested in IAG. Share price is down a lot compared to before the coronavirus. What's your view on IAG?
Well, I think unfairly beaten up. I mean, the biggest problem IAG's had, and as has QBE to an extent, and other insurers, of course, is this business interruption risk following COVID-19.
Oh, yeah, that's right.
And the issue around, the policy warning, was a pandemic part of the exclusions or not? And there's been a couple of cases and they lost one and they've now fully provided for it. So that's going to, at some stage, you've got to guess, mean a pretty big payout. But they've got over that. They raised capital. I think the market's still a bit unkind to them because they are raising premiums. And as you say in your article, insurance is a bit of a grudge purchase, and sometimes that slips off during when times are tough, but it'll come back. So I think IAG's, if I had a look at any of those stocks, Peter, that's probably has the biggest upside for me. Maybe not the next 6 months, but I think over the next couple of years. So, I do always have a bit of fear about insurance because we know that you can get these one-off events.
Yeah, you can. And the thing is, I like them when the share price is low. When they're high, a one-off event can knock them around. Let's go to the next one. Qantas. Qantas hasn't been beaten up. My chart actually showed they're actually doing pretty well.
Yep.
But they're a long way off their best. So what do you think, Paul?
Yeah, again, you've got to be patient on Qantas. I mean, Qantas will do really well when we'll get back to normal. Yeah. And there's no doubt that it's used the whole crisis to reduce costs. It's used the whole crisis to increase revenue because of what flights they are getting away at the moment. They're all selling seats at a premium rate.
Yep.
As you say in your article, Peter, Virgin is going to be sort of the second-class airline.
Yeah.
It'll eventually go fully down market, I guess, and be more a competitor to Jetstar. It'll go back to the old days. And Qantas will be left with the business and the luxury travel market and through Jetstar, its low-cost brand, that part of the marketplace, and be in a really strong position.
Yeah, it's sort of moving to a pretty good runway in the future.
So again, I guess I wouldn't be rushing to buy Qantas tomorrow because it's probably got a fair bit of the recovery priced into it. But the next time the market gets a bit bearish, we have another outbreak, borders closed down, that's the time probably to buy Qantas, right?
Yeah. Okay, let's go to one that worried me, but it's a fair story to run with, Telstra.
Yeah, a lot of us have got burnt expecting better things of Telstra over the years, and I think we've basically learnt that below $3 it's a buy, and it gets much above that it's a sell, right? Yeah. Now it's sort of $3.17 on the way back up. The chart shows it's getting higher. Been very quiet at Telstra. Been on radio silence now since their AGM in October, which I think is good news. Clearly,
if there's something wrong, the CEO has to fess up, doesn't he?
Which also means they're working hard, I think. Yeah. Also, there's the other upside for Telstra is there is going to be a breakup in terms of a restructure with an infrastructure part potentially being spun off, and they announced that back in October, so we might get some news about that. I think the only issue with Telstra, the negative side, is about the progress they're making to their FY23 earnings target. This is when the earnings start to grow again in a post-NBN environment. Remember, Telstra's been negative earnings now for I don't know how many years, declining earnings, declining revenue. This is the time earnings are due to start growing again. And that's been obviously reflected in the ability to hold the dividend. But I'm expecting we'll get more positive news about dividend, not going up, but at least confidence about the 16 cents. Through an interim of 8 cents, and probably I think that this is a stock, if I had to say this stock of upside, that is a surprise, and it'll come this Thursday. I'd say Telstra could be one, right?
Yeah, and like Macquarie,
I'm not sure I want to go and buy it now on that chance for Telstra, Peter. But
Macquarie is the only one with supersonic positivity. They've got a $4.
That's a brave call.
Isn't it? $3.50 I can feel comfortable with. $4 is a brave call, but still it's out there, and I thought I should share it with you. The final one is one I really like. The analysts aren't as supportive as I am, but I am taking a long-term view. These analysts we're talking about, you wouldn't expect much more than a 6-month view, is it, Paul?
No, generally it's a 12-month target, and that's how they say it is. Yeah. But you get very influenced by what's going on now. I mean, there aren't too many analysts that are prepared to have what you'll notice is the share price creeps higher, so do the broker valuations. Share price goes down, so do the broker valuations. Okay. So it is a little bit of follow the market.
Okay. And we're talking about Xero here, I should say. That's the company I like it for the long term. Not sure about the short term, but Paul, what do you think?
Look, one of my favourite stocks, I couldn't work out why it suddenly went through $157 at the end of December. It went crazy.
Was it the tech-related stuff, Paul?
Yeah, I mean, I think Xero's probably back you know, as a stock I want to own, I think it's a great company. That's the chart. I think you can be a little bit patient on Xero. It has got a couple of headwinds, Peter. It is increasing revenue. I think you wrote about that today, but it does have to continue to build its base offshore because the Australian market is reasonably saturated. It can't keep winning share in Australia. It's done a lot of work on its ecosystem in terms of, you know, getting people just don't use it for accounting, they use it for invoicing, they use it for other data, and other ways to sort of generate more revenue per customer. They call it the ARPU number, average revenue per user. Watch that, it's a key number coming out in their report. But their growth in Australia is slowing and Australasia is slowing as you expect. So Xero is now about the US and the UK, and that's harder markets, not because they're not great products, it's just harder for an Australian company to crack it. And so, look, maybe it got a little bit ahead of itself. I think at $157 it did. This is in my radar to buy. At $130, yeah, it's sort of, I think maybe it's got to come back a bit more.
110, you'd jump in at 110, wouldn't you?
I want to see it back close to $100, but I'm a holder, and therefore I can afford to be patient on it. It is a great company. It goes into all our portfolios. And I think of any of the IT companies, Afterpay included, it's the one I feel most comfortable about holding.
Yeah, okay. So that's my assessment. If you want to read more, have a look at the Switzer report. You can have a 21-day trial. We do lots of companies for each report, and over the week, a lot of companies as well. And we've got some really great writers. Paul, of course, is one of those great writers. Tony Featherston, who was the former business editor of BRW magazine.
I reckon, Peter, one of the best in the business, if not. I won't put our other contributors down, but probably I rate him number one in Australia.
His skill set is terrific when it comes to assessing companies. And James Dunn was probably one of the most recognised finance company reporters in the country as well. He's also contributing with people like Rudy Philippek, Van Dyke and Julia Lee. So if you're looking for some sort of guidance in buying stock, have a look at that. Thanks for joining us, Paul.
Thanks, Peter.